Welcome to this custom-tailored deep dive. We are thrilled to have you with us today.
Yeah, really glad you're joining us.
Whether you are prepping for a big meeting, trying to catch up on corporate strategies, or, you're just an insanely curious person who loves learning how the world actually works, you are in exactly the right place.
Absolutely.
Today, we have a fascinating mission. Our source material is a single, dense document, but it is an absolute goldmine of business intelligence.
It really is.
We are looking at Domino's Pizza, Inc.'s 2025 annual report.
Which, annual reports can often be a bit dry.
Oh, totally.
But this one tells a remarkable story if you know how to read between the lines. It completely subverts what you might assume about the fast food industry.
Right. And our mission for you today is to look right past the pizza boxes.
Right.
You're going to extract the hidden business mechanics of one of the world's most ubiquitous food brands.
Because it's not what you think.
Not at all. By the end of this deep dive, you're going to see exactly how this company actually makes its money.
It rarely is what you expect when you look closely at operations of this scale. I mean, the front-facing product is often just a delivery mechanism for a much larger, more sophisticated back-end strategy.
Yeah, but before we get into those back-end numbers, we have to talk about the visuals in this 2025 report. Because the corporation absolutely knows what business they are fronting.
Oh, they definitely do.
The imagery peppered throughout these corporate pages is designed to just grab your attention and your appetite.
It is highly effective marketing, even within an investor document.
We are talking about tantalizing, extreme close-ups of gooey cheese pulls stretching from a fresh slice.
Making me hungry just thinking about it.
Right. You flip a page and you see these perfectly baked crusts, beautifully dusted with garlic seasoning, vibrant, bright green jalapenos resting on sizzling, curled pepperoni.
They are reminding the shareholders what the end consumer is emotionally connecting with on a Friday night.
Exactly.
Right.
And then there is a shot of a rich, powdered sugar-dusted chocolate lava crunch cake oozing from the center right there on the page.
It's a very deliberate choice.
I was definitely getting hungry just reading the financial disclosures.
Hard not to.
Okay, let's unpack this, because as mouth-watering as that food is, the financials paint an entirely different picture of what is going on.
A completely different picture.
We need to transition from the pizza to the balance sheet and figure out what these numbers are hiding in plain sight. Let's start with the sheer scale of the operation.
The scale is the perfect place to start because it shatters the illusion of the neighborhood pizzeria.
It really does.
When you order from Domino's, it feels inherently local. The driver might live down the street, and the store's probably just around the corner in your local strip mall.
Right, it feels like a small business.
Exactly. But the 2025 numbers paint the picture of a staggering global empire. By the end of 2025, they reached 22,142 total stores.
Over 22,000 stores. That is a massive global footprint.
It is huge.
But the breakdown of those 22,142 stores is the stat that completely reframed the company for me. Out of all of those locations, nearly 15,000 are international.
So the vast majority aren't even in the United States.
Right. Then you have roughly 6,900 U.S. franchise stores. So out of over 22,000 global stores, take a guess at how many the corporation actually owns here in the U.S.
Knowing their asset-light strategy, I would assume it's a tiny fraction of the total.
Barely over 1%. Just 262 stores are U.S. company-owned.
Wow.
Why would a company that big own so few of its own storefronts?
What's fascinating here is the absolute brilliance of the franchise model when it is pushed to its logical extreme. By minimizing the number of company-owned stores, Domino's dramatically reduces its own corporate overhead.
Because they aren't paying the rent.
Exactly. Think about the logistics of that. The corporate entity doesn't have to sign 22,000 commercial leases. They don't have to directly manage the payroll, the benefits, or scheduling for hundreds of thousands of store-level employees.
That sounds like a massive administrative relief.
Oh, it is. They effectively offload the local operational risks, like finding real estate, hiring drivers, and dealing with local regulations. They push all of that to the franchisees while maximizing their own global brand reach.
So they get all the omnipresence without the day-to-day headache of managing the actual pizza making at a local level.
And the growth numbers validate this strategy completely. Look at their net unit growth for just the year 2025 alone. They added 776 net new units in a single year.
Nearly 800 stores in 1 year.
Yes. And to tell the story of that global reach, 604 of those new stores were international. They also added 167 U.S. franchise locations and only 5 U.S. company-owned stores.
Just 5.
The expansion is happening almost entirely through their franchise partners.
They're essentially crowdsourcing their own global expansion. Here's where it gets really interesting, because if they aren't selling the pizzas directly to the consumers at 21,000 of these stores, where are the billions of dollars in revenue actually coming from?
That is the big question.
In 2025, Domino's reported $4.94 billion in total revenues. But the majority of that doesn't come directly from selling pizzas to hungry customers.
This is the pivot point where you have to completely change how you view the brand. You have to look at the revenue streams in proportion.
Let's group these 2025 revenue numbers together so you can see the puzzle pieces. Remember those 262 U.S. company-owned stores?
Right.
They brought in about $375.2 million. That is a lot of money, but it is a drop in the bucket compared to the total.
True.
Then you have the U.S. and international franchise royalties, plus the U.S. franchise advertising revenue. If you lump all those royalty and advertising fees together, you are looking at roughly $1.5 billion.
Specifically, $677.1 million from U.S. royalties, $559.5 million from U.S. advertising, and $338.7 million from international royalties.
Exactly. So if you add the company stores, the domestic and international royalties, and the advertising fees together, you are just scraping past $1.9 billion.
But the total reported revenue is almost $5 billion. There's a massive gap there.
You are missing the biggest piece of the pie. And that piece is listed in the report simply as supply chain.
Supply chain.
In 2025, the supply chain revenue was nearly $3 billion, specifically $2,989.5 million. Out of a $4.9 billion total, nearly $3 billion comes from the supply chain alone.
When you look at that $3 billion figure, you realize that Domino's is not really a pizza-making company.
Not at all.
Domino's is essentially a massive, highly optimized supply chain and logistics company. They just happen to serve a dedicated, captive client base of franchisees who sell pizza to the public.
They are the ultimate middleman for their own brand.
It is a brilliant defensive strategy. Think of it like the gold rush in the 1800s.
The picks and shovels.
Exactly. The people who consistently made the most money weren't the miners panning for gold. It was the merchants selling the picks and shovels. Domino's isn't mining the gold. They aren't out there trying to sell individual $20 pieces to consumers at scale. No. They are selling the picks and shovels. By running the supply chain, corporate Domino's sells the fresh dough, the massive blocks of cheese, the branded cardboard boxes, the pepperoni, the jalapenos we saw in those glossy photos.
They sell all the raw materials directly to their thousands of franchisees.
Precisely.
So the franchisee isn't just paying a percentage-based royalty to hang the Domino's sign above the door. They are contractually locked into buying their ingredients from the corporate supply chain network.
Which achieves two massive strategic goals simultaneously. First, it ensures absolute quality control and consistency across the globe.
Because a pizza in New York tastes exactly like a pizza in Nevada.
Exactly. Because the core ingredients are sourced, processed, and distributed by the exact same central corporate logistics network. They have a fleet of trucks running these ingredients out to stores constantly.
Makes sense.
But second, and more importantly for the investors, it locks in a massive, guaranteed revenue stream that transfers risk.
How does the risk transfer work in practice? Let's break that down.
Well, think about what happens during periods of high inflation, or when commodity prices for wheat or dairy spike. The corporate supply chain can adjust the prices they charge the franchisees for the dough and cheese.
Oh, wow. So corporate protects its margin.
Yes. The franchisee feels the squeeze on their local profit margins, and they have to figure out if they can raise menu prices in their specific neighborhood without losing customers.
So the local operator bears the friction of the retail market.
Meanwhile, corporate still gets paid for the supplies. Whether a local store has a highly profitable month or is barely scraping by, they still have to buy the raw materials from the mothership just to keep the ovens turned on.
That makes perfect sense. The corporation gets paid before the pizza is even baked. It guarantees corporate revenue even if the local franchisee is stressed.
It creates an incredibly resilient business model at the top level. You can see this resilience when you look at the steady climb in their total revenues over the last few years.
Yeah, the year-over-year numbers are impressive.
In 2023, total revenues were $4.47 billion. In 2024, they climbed to $4.70 billion. And then in 2025, they hit that $4.94 billion mark.
And the supply chain component.
The supply chain alone grew from $2.7 billion in 2023 to nearly $3 billion in 2025. It is a machine that just keeps scaling up regardless of broader economic fluctuations.
That is staggering consistency. But we also have to look at the health of the empire on the retail side. Because, as you mentioned, the franchisees are bearing that local retail risk.
Right, they still need to move the product.
They still need to be selling more pizzas to end consumers to justify buying more supplies from corporate. If the local stores fail, the supply chain has no one to sell to.
True.
Fortunately for Domino's, the sales metrics in the 2025 report show that despite this massive global footprint, the end consumer demand is still growing. Global retail sales growth for 2025 was up 5.4%, excluding foreign currency impacts.
That 5.4% is a vital metric because it indicates that organic, real-world demand is still expanding. They aren't just opening new stores to pad their numbers. The overall volume of pizza being purchased globally is increasing.
And we can see that when we look at the same-store sales, meaning stores that have been open for at least a year, so we can accurately measure their year-over-year performance. Same-store sales grew by 3.7% in the U.S. and 1.9% internationally in 2025.
Consistent growth.
So what does this all mean?
It means the entire ecosystem is highly profitable. Let's look at the bottom line to answer that. All of this logistics dominance, franchise expansion, and supply chain management resulted in an impressive $954 million in income from operations for 2025.
Nearly $1 billion in operating income.
And when you distill that down, after taxes and other expenses, their net income was over $601.7 million.
Over $500 million in pure profit for the year.
And for the shareholders, the metric that really matters is the diluted earnings per share, or EPS, which came in at $17.57 for 2025.
So for you listening, that essentially means for every single share of stock someone owns, the company generated over $17 in pure profit this year.
Exactly. And to put that growth in perspective, just 2 years ago, in 2023, the EPS was 14.66. So the value being returned to the people holding the stock is climbing aggressively.
If you want proof that Domino's views itself fundamentally as a tech and logistics company rather than just a culinary brand, you just have to look at who holds the power in the boardroom.
Leadership always tells the real story.
The annual report lists the key players running the show from their headquarters in Ann Arbor, Michigan, and the executive titles perfectly reflect this back-end business model.
The leadership roster of any major corporation tells you exactly what that company values most.
You have Russell J. Weiner as the chief executive officer and David A. Brandon as the executive chairman. But the specialized roles right below them are what stood out.
What did you notice?
You don't see a head of pizza innovation featured as prominently as you see Kelly Garcia, the executive vice president and chief technology and data officer. Right.
And right alongside him is Cindy Hedden, the executive vice president and chief supply chain officer.
Those two roles right there, data and supply chain, that is the beating heart of the $4.9 billion operation.
It really is.
If Domino's were just a neighborhood restaurant franchise, you wouldn't need executive vice presidents dedicated solely to global data architecture and supply chain logistics at the very top of the hierarchy.
Not at all.
Their presence directly reflects the company's true operational focus. They are managing the flow of ingredients from massive regional distribution centers, and they are managing the flow of millions of digital orders through their app and website.
It is amazing how looking at a simple org chart can completely validate the financial data we just uncovered.
It aligns perfectly.
And speaking of the shareholders who are benefiting from the work of this executive team, there's a fascinating little detail in the report about how the company interacts with its investors today. The modern shareholder experience has completely evolved, and this report highlights that shift perfectly. It notes that their upcoming 2026 annual meeting of shareholders is scheduled for April 21st, 2026.
Okay.
But what is notable is that it is a virtual-only meeting.
No grand ballroom, no physical gathering with a catered buffet in Ann Arbor.
Nope. It reflects a very modern, streamlined corporate approach that avoids physical real estate whenever possible.
Which fits their business model perfectly.
Investors will attend online, view the financial materials, cast their votes for board members, and submit their questions entirely through a web portal.
It's highly efficient.
It cuts out unnecessary event overhead and allows global shareholders to participate seamlessly from anywhere in the world. In a way, it mirrors their entire franchise model: digital, distributed, asset-light, and highly optimized.
That is a perfect parallel. It is all about efficiency and scale, from how they deliver the dough to the stores, all the way to how they collect shareholder votes. So, to summarize the key takeaways from this report for you, the next time you order a pizza and you open that cardboard box and you marvel at the perfect cheese pull, or the garlic seasoning on the crust, or those bright green jalapenos.
Which still look amazing.
Right. You need to realize you aren't just engaging with a local restaurant. You are interacting with the endpoint of a $4.9 billion logistics, data, and supply chain behemoth that is cleverly disguised as a friendly neighborhood pizzeria.
If we connect this to the bigger picture, this is why diving into primary sources like annual reports is so vital.
Absolutely.
Understanding a company's true revenue driver like the fact that Domino's makes nearly $3 billion from selling supplies to its own franchisees rather than direct retail sales is the ultimate shortcut to being an informed investor or a sharp business observer.
It changes everything.
It completely changes how you evaluate their risks, their opportunities, and their future. You stop looking at them as competing just with the local mom-and-pop pizza shop.
You start seeing them as competing in global logistics, fleet management, and supply chain optimization. It is a completely different lens to view the fast food industry through.
And looking through that lens, this raises an important question for you to mull over.
I love this part.
If a pizza company is actually a logistics and supply chain business at its core, what happens next? Think about the rapid advancements we are seeing in technology today.
Right.
What happens when automation, drone delivery, and artificial intelligence completely eliminate the remaining human friction in that supply chain?
That's a huge thought.
Does the traditional franchise model where a human operator takes on the local retail risk eventually become obsolete? Or does it mutate into something entirely new, something we've never seen before in the fast food space?
The business of tomorrow is being built on the logistics of today. Thank you so much for joining us on this custom-tailored deep dive. We hope we delivered that new perspective and gave you a fresh way to look at a brand you see every day. Keep your curiosity sharp, keep looking past the obvious, and we will catch you on the next deep dive.